Okay, great. So we have a lot of folks signed in. It's just a little after 12, and we now have Brian with us. So just want to get started here. Welcome everybody to this is part 4 of the 6-part webinar series that we've been doing. And today we're going to talk about taxes that are related to real estate transactions. And to start off, and I always say this when I start any of these seminars, this is not intended to create any CPAs out of the group that's here. I know most of the folks who signed in are realtors, and this particular webinar is directed specifically at realtors. And I think the takeaway is we want to be able to identify things that affect our real estate deals even before we put them together. It's incredibly helpful if you understand some basic tax rules, because you're going to get asked these questions quite often by your customers. And if you have a little bit of an idea, you can often point them in the right direction. You might be able to give them a tip to call their accountant or check with their attorney about something, and you end up saving them a lot of money. I'll give you a few examples as we go through this, but they'll never forget someone who actually gave them a good tip and saved them some money. That's something that'll stand out in their minds. So there's a number of rules in New Jersey specifically that affect real estate deals. We're going to talk also about taxes on a federal level and just general thoughts of how you structure real estate deals. So before we get started, I want to introduce Brian Lovett. Brian is a CPA and also an attorney. We met because we actually put this presentation on about a year ago at the State Bar Convention together for a group of over 100 attorneys. So this is going to be a slightly different program because we're not going to get into all the nonsense with the forms you have to fill out that lawyers are saddled with, but rather we're going to look at the big picture of what's happening in a transaction. So Brian, you want to just say hello and tell a little bit about your background?
So my name is Brian Lovett. I'm a partner with the accounting firm of Withum Smith & Brown. I did have the pleasure of joining Brad last year in Atlantic City, so this is a little bit of a different method of delivery for this one, but my practice involves probably 80% is real estate transactional, real estate entrepreneurs who own and lease real estate, residential and commercial, do a lot of planning and structuring for those owners, qualified opportunity zones, 1031 consulting, and a whole bunch of real estate tax compliance. So I appreciate everyone's time today and look forward to this discussion.
And for anyone who signed in who has a friend who might have missed this or wants to see it, we're going to record today's webinar, and so it'll be available on my website, and you can check it out anytime. It'll probably take a day or two to get posted, but please check in. And we're also going to be talking about a lot of documents and forms today. If you want a formal handout, just send me an email at brad@batchelor.com. That's BATCHA, and we'll send you back a copy of the handout that we're going to go over, because there's a lot to take in. If you want to take some notes, that's great. But if you want to get the handout, I think that'll be helpful. So we're going to start off today talking about something called bulk sales. And for anyone who does real estate, you'll notice in your boilerplate contract that you do for all the residential deals, there's a whole paragraph that has to do with bulk sales. It's a unique act to New Jersey, and it was actually created not for real estate, but it was created for when the bulk assets of a business were sold. They wanted to make sure that they were all paid up to the state of New Jersey, any taxes that were owed. So they created a system where a prospective buyer was required by law to send a notice into the state. The state would run some searches and make sure that the seller was current. And if they were, they issued a letter of a clearance letter. Or if taxes were owed, they would send a letter that you must send these taxes in. So it really protected two entities. It protected the state, who wanted to collect their money, and it protected the buyer. So they weren't buying an asset that potentially had any claims on it from the state. So this was created in 1966. And like I said, real estate was really not a thought when this was created. It was really solely for business assets. And the basic rule is, and this is important too if you're doing real estate deals, the basic rule is that you have to, 10 days before a closing, send in some form called a C-9600. Don't worry about it. You're not going to be the one filling it out. And it's got to get to the state. Why is that important for agents to know? Well, one thing is sometimes people forget to do it. So if everyone's aware of this and say, hey, did the bulk form sales notice go out, hopefully it doesn't get forgotten, because I've been in deals where the other side didn't send it out and we then had to wait 10 days. And while the law says 10 days, the way the bulk sales team interprets it is 10 business days. The law actually is written and says that you have to send it in 10 days before the closing. They interpret it, because I did a panel webinar or seminar with the whole bulk sales folks in New Brunswick a few years ago. They interpret it that they must receive the notice 10 business days before the closing. So that's a big difference than sending it 10 days before the closing. So we always send things by overnight mail so we can document when they get there, and they get there very quickly. And we never close without the letter. I mean, even if the 10 days go by and we're saying, oh, you know, it's been 10 days, we probably are clear, you never close it. And the reason is because the remedy for failing to send in the notice is so incredibly drastic. The remedy under the law says that if you don't send the notice in, the buyer becomes personally responsible for all the taxes that the seller owes, which is crazy. And it's not even limited to the purchase price of the asset. It could exceed that. So it's an incredible, I don't know that it's ever been fully enforced, but that's exactly what the law says. So we have to be very cautious about sending this notice out. We got to send it out on time. We got to get a clearance letter or a response for an escrow before closing. You'll find, I used to put in my attorney review letters that the seller had to comply and they had to do this. And I would often get pushback from sellers who thought they were exempt or didn't want to do it, and sometimes even canceled the deal over it. I don't even put it in any of my letters anymore, because the realtor's form contract has been updated and it's pretty good. It says if the buyer chooses, the seller shall cooperate and fill out the form, because we need information from the seller in order to send this form in. But what's missed a lot is it's the buyer's attorney's responsibility to do it, or the buyer's side. And it's a little tricky because, you know, I mentioned before, the remedy is that it's a personal obligation of the buyer to pay the tax. Strangely, and probably because when it was drafted, it wasn't intended for real estate, it's not a lien on the property. So if a buyer doesn't have a lawyer, the title company's not going to care, or it's not their obligation to send out the bulk sale notice. So it's honestly, it's a terrible trap for the unwary in New Jersey who are buying a property that's owned by an LLC. We'll get into the exemptions, but I actually wrote an article which was published last year by the State Bar Association about the fact that I don't personally believe bulk sales should apply to residential properties, but it does. It applies to residential properties if they're owned by LLCs or corporations. So, like I said, this was started in 1966. The act was actually amended in 2007. And that's when it became applicable to real estate. So historically, it was called the sales and use tax, because that's really what they looked at. But when it was amended, it opened it up to all types of taxes and all business assets, which was a much broader definition. And that's when the real estate kind of came into play. So whenever you're selling a piece of real estate that could be considered a business asset, you had to send the notice. So it turns out everything is effectively a business asset that's real estate, except for your personal use residences. So if you own a vacant lot, that would be interpreted as a possible property that was held for investment purposes. So they did create some exemptions. The exemptions weren't created initially. So when 07 came around and that act got changed, we were sending bulk sales notices in all the time. But they finally did come out in 11 and clarify that if you were selling a house, a simple dwelling house, a 1 or 2 family house, you did not have to send a notice in, provided that that house was owned by an individual person, a married couple, a trust, or an estate. So that was pretty clear. The only problem with that is that if you had 2 individuals after the 07 amendment, 2011 amendment, you still had to send in the notice. So if a brother and a sister own the property, you'd have to send the notice in because the state deemed that to be a partnership. One of the last bills Christie signed before he left office in 2018 slightly modified that exemption, and it said it could be multiple individuals or trusts or estates. It didn't just have to be a single individual. So that was nice. So there's a lot less notices we have to send, because often when you're doing real estate deals, it's owned by an individual, it's owned by two individuals, a trust or estate. But it left open that any property, even residential, owned by an LLC or corporation was deemed to be a business asset. So we have to send the notices in. Now, there's one more exemption, and this is probably the trickiest one. It's called the ordinary course of business exemption. And this is reserved for the large corporations. You might see US Homes, Toll Brothers, that are selling large tracts of land. They have 100 units. They don't have to send a bulk sales notice in for those guys. They are monitored in a different way. So they're exempt because of the ordinary course of business exemption. The problem with that is every builder on the planet thinks they're exempt, and they're not. It was interesting when we did that panel discussion with the bulk sales team. They told us stuff that we were, shocked at, and said, even if you have a builder, for example, who has 10 units, the first unit they sell, they don't deem to be in the ordinary course of business because they haven't established the course of business yet. And fine, that's one thing. But then they said the last property you sell to is also not in the ordinary course of business, because now it is the very last asset that they're selling. So as a buyer's attorney or a buyer, how can you ever understand fully whether or not it's a ordinary course of business exemption? So I think the safe play, and this is what I tell all the attorneys to do, is send the notice in no matter what, unless you're very convinced that it is a large corporation, that this is what they do. It's a Hovnanian, it's Toll Brothers. You don't want to waste your time. They're going to be exempt. But there are a lot of small builders where they object to this, because what happens with the bulk sale when there's money owed is they take the money from you the day closing and they stick it into a fund, like a withholding from your taxes. And if you end up owing taxes, that's a credit towards what you owe. If you don't owe taxes, you get that back. So if I'm a builder who wants to roll my money over and invest it in a new property immediately, it's bad when the money is taken away from me, even for a short period of time. And that's why these builders were objecting. So I don't want to make the call. What I instruct them to do is, if they're so confident that, and this is what bulk sales told me too, if they're so confident that they're exempt, write me a letter, explain why you're exempt, show me the transactions, give me a letter from your accountant. I'll send that in with my bulk sale notice, and 99% of the time, they'll send me back a clearance letter. And that way, it takes the decision-making off of us, because if we make a mistake, our client's still liable. If bulk sales makes a mistake, we're fully clear. Brian, have you had any experience with bulk sales or trouble with that office? You don't really have to deal with it quite as much as CPA.
I deal with it on the other side. So where I deal with it is, once the bulk sale, the C-9600 is filed, I deal with, mostly it's my clients are the seller, and we're working with them on the TTD and trying to reduce the escrow. Yeah. And, try to move that quickly through, because none of my clients want the escrow, and, we got to file with TTD, or we're doing a 1031 exchange. So we don't want any escrow at closing. So we have to act quickly to get that TTD form over to the bulk sale representative. That's the side we deal with it mostly, is in trying to reduce the escrow and make this efficient, make it more efficient.
So Brian mentioned the form called the TTD. It's an asset tax transfer declaration. And that's a form that's very helpful. If a seller knows that they might be subject to bulk sales, they're should be told to contact their accountant, what I always tell them, and fill out this form. We can send it in with the initial notice, or when we get the escrow letter back, they can supplement it by sending in the TTD form. So they'll reduce the escrow down to a reasonable amount. Because when bulk sales sees these things, if they see like $100,000 sale, they'll just multiply times 8.9% or something and say, okay, send us 8,900. But if Brian comes in and says, oh, well, they bought it for 60,000, they put 20,000 of improvements in, it depreciated 10, and we have to pay the realtors, and when it all shakes out, we're only going to make 15 profit. So multiply that times the 8.9, and we only actually owe, about $1,000. Once he goes through that analysis, they, again, 99% of the time I've seen, I don't know about you, Brian, but they typically will go along with an accountant's letter on a TTD and reduce the escrow.
Yeah, most often we're able to get it reduced and reduced relatively quickly. It's nice to send it along with the C-9600 request, but a lot of times what I find is The buyer goes ahead and files a C-9600. The client, as the seller, knows that they're subject to bulk sale, but they're not necessarily involved in the filing of that 9600. We get the escrow letter back. They look at the amount on the escrow letter because, like you said, it's a percentage of the gross sales price with no accounting for costs and basis and losses inside the partnership. And then they panic about the escrow amount. So then we get involved and we work directly with the bulk sale representative to get that freed up. But they are usually pretty quick and pretty good about getting it dropped down.
So 2 takeaways as agents: if you're representing a buyer and they're buying a piece of property that's owned by an LLC or a corporation, or if it's a commercial property, the bulk sale notice needs to go out. If they're working with an attorney who knows what they're doing, they'll be protected. God forbid you have a client who's working with a title company. There's no one really there to teach them or tell them that they have to do this. Some title companies may weigh in on it, but it's not required because it's not a lien on title. So just remind all your customers that are in that situation, make sure someone sends out the bulk sales notice early in the process so it can go through. Sometimes it take 2-3 weeks before we get that back. If you're on the sell team preparing for closing, notify them, look, this bulk sale might come out and you're gonna need to be prepared to either show why you're exempt or get your accountant to fill out this form, which will lessen the escrow that they're gonna charge you closing. So the next topic we're going to tackle, and this is also unique to New Jersey law, is the realty transfer fee, the mansion tax, and the exit tax. Those are taxes that come out on the day of closing and get paid to the state. So we're going to go through each one because some of them there are really good exemptions for. And again, I've seen them get missed where clients should have been exempt, that they did not get the exemption. And I don't know why. And there are ways to go back and fix that if there's a problem. But understanding the rules going in, I think, is helpful. So the realty transfer tax has been around for years. Back, I think, when McGreevy was in, they did a huge change from the rate. The rate was approximately 0.5% at the high end, and they upped it to 1.2%. At the same time, they added the mansion tax. And the reason that was done, I was told, is because comparatively to the states that surround New Jersey, Pennsylvania, Maryland, New York, we were on the low end. You know, we were about 0.5% take on a real estate deal, where the other states were probably 2, 3, 4% on some of the, depending on what county you lived in. So we were really getting on par with our neighboring states when we made these adjustments. But now we're stuck with these laws, and the high end is 1.2% for the marginal tax rate, and that's pretty much north of $1 million. And so if you're looking for a rule of thumb, what a client's going to pay, it's about a little over 1% if it's a high price property. Lower price properties are more modest, and we can look those rates up because there's a progressive tax and there's lower rates at lower numbers. If there's a transfer between a parent and a child, that's fully exempt. And I've seen people miss this before. I don't know why, but this is, even if it's only, you know, a married couple and they have their daughter is buying with her husband, that's a fully exempt transaction. If they were selling to the daughter and the boyfriend, 50% of the deal would be exempt, and they would have to pay the transfer tax on the other 50%. So there's a lot of transactions, because I think what people think is, oh, well, when there's a gift from a parent to the child, that is exempt. No, even if they're selling for $500,000, because of the relationship, the law says there is no transfer tax. This holds true too if there's a divorce and there's a court order that says the property goes from the husband to the wife. It doesn't mean if you sell to a third party in a court-ordered divorce that there's not a tax, but just between the spouses, there is no tax. Same thing if there's a deed from an executor to a beneficiary, or, and this one gets a little tricky, anytime the consideration is under $100. But with one major caveat, the caveat is if there's a mortgage on the property, the state deems that the balance on the mortgage when it's transferred acts as consideration. So if I want to gift my home to somebody and I have a $300,000 mortgage on it, I can't just check off the box that it's less than $100 consideration, because arguably the person I gave the property to is taking over that mortgage. So we have to pay the realty transfer tax based upon the outstanding amount of the mortgage. So there's actually a box you have to check on the form to verify that. A lot of times, and this is more applicable when I give a talk to attorneys, but a lot of times a client will call or come in and say, hey, can you do a deed for me? How much would you charge for that? And so that's a really loaded question, honestly, for a lawyer, because we have to look at all kinds of things like, what is the transfer going to mean? Is title insurance going to transfer over if we make this transfer? We have to look into that. So it gets a little bit tricky, and it's not something you want to just agree to do. We also have to look at the Fraudulent Transfer Act. Why are you transferring it? Is it because someone's chasing you for money? Because if you do that, you could be subject to treble damages. So when people just want to do deeds, they really need to consult with a lawyer. They should never just go online and fill out a form and record a deed, because they don't know what they're getting themselves into. We also have a couple of partial exemptions in New Jersey, and these are the most commonly used one is the one that's for a senior citizen. So if either spouse is over 62 years old, the property, and it's their primary residence, the property is eligible for a partial exemption. Now, the partial exemptions are about 50% of what you normally would owe. So if you normally owe about 1%, they'll drop it down to a 0.5%. So it's a huge difference. The same is available for anyone who is blind or disabled. But there's a couple rules that go along with this. It's not just that you have to be 62. You have to be a resident of the state of New Jersey, and it has to be owned and occupied by you at the time of closing, and it's got to be a 1 to 2 family residence. So sounds pretty simple, but it gets a little tricky because sometimes people will sell their house and move to Florida or the Carolinas, and they say, well, no, that was my principal residence. But if you've now established residency in another state, you don't get the discount, because you can't swear and sign off on an affidavit on the day of closing that you're currently a resident of the state of New Jersey. Likewise, if it's not owned and occupied, if there's someone living there as a tenant, you can't do that either. When I had we did another seminar with the Division of Taxation folks there, and we asked them a lot of questions about this. And we said, sometimes people do need to move, and then the market's not good. Is it fair to charge them that? And they said, look, if they move and they're living now in another state, they have to pay the full vote. They said the only exemption, and this is just what the Division of Taxation says, it's not codified anywhere. They said if an elderly person was sick and got moved into a nursing home and the closing happened within a year, they would deem that to be eligible for the senior discount. So it's a little bit tricky. If you owned property as joint tenants with the right of survivorship, both people need to qualify. But if you're married, only one needs to qualify. So there's some technical differences there that only really an attorney who's looking into the law on that would know. All right, so next one we're going to talk about is the mansion tax. Mansion tax was started, again, back when the rates were changed for the transfer tax, and that's a 1% tax. Now, it's only on properties that are over $1 million, and it only applies to commercial properties, residential properties, and farm properties. It actually doesn't apply to vacant land, which is a little bit strange. And the other thing that I've done in the past is, if a buyer is buying something, usually for cash, because banks don't typically want to do this, they're buying multiple lots, like 2 or 3 lots that are adjacent, we might do 2 or 3 deeds, because if the property is on one, the residential property, you're going to have to pay the tax on only if it's over $1 million. Sometimes if you split up the transactions, no single transactions over $1 million, so you don't have to pay the mansion tax in order to record the deed. The other thing we had done is there was a property that had a home on it, and we had them agree to remove the home before closing because we were going to tear it down, and that way it avoided the mansion tax because there was no home there and it was just vacant land. The grayer areas, and you see agents sometimes or buyers and sellers try to play with this, is when we get a deal that's very close to $1 million and they say, well, wait, how can we structure this? We're so close, we don't want to pay that 1%, $10,000. There's a lot of tricks that people play. I don't know that they're all legit. The one area which I would agree is fully above board and legitimate is when you have a significant portion of the sale that is personal property, and you want to shift that personal property outside of the deed and the real estate contract. We can take the personal property, and my advice is always to itemize each particular item and give a fair market value of the used property you're buying and do a separate contract for that. So, you know, the state is not intending to tax personal property. And most people don't parse it out, they just kind of lump it in. But you could parse it out if you're honest about it and if you do it in a fair way where you say, okay, I have, you know, these pieces of furniture we're buying and we have these couple of, you know, freestanding pool tables, appliance, whatever it might be. We put a value on it. I usually like to see the receipt from when it was bought and then a discounted value for the use. And we add that up and maybe it's worth 15 or 20,000. We could maybe take a deal that's at $1.010 million and drop it to the 990 and do a fair and accurate accounting of that and then do 2 transactions and avoid the mansion tax. Other folks will say, well, we're going to have the buyer pay the real estate commission. You might get away with it, but I think arguably that's consideration for the deal. If you're already you've signed a listing agreement with an agent to pay them, you owe them a fee. And if you shift that burden of paying the fee to a buyer, that's consideration for buying the deal. Just as if they had to take over another loan for you or another payment for you in addition. It's not really, I don't think, a clear above board way to handle the transfer tax. The only one I think is fair is when you're moving the personal property aside. And in fact, we do it all the time when we have business deals. You know, we always sell the personal property separately. And banks don't want to lend on personal property. So it's actually more transparent when you do it that way because banks don't want to lend on anything that could be picked up and walked away with, which would be deemed to be personal property. So the final one we're going to talk about for the taxes at closing is often referred to as an exit tax, and that is a misnomer. There is no such thing in New Jersey as an exit tax. There is not a situation where you are taxed differently because you leave the state versus someone who remains in the state. However, there is an exit withholding. You are treated differently if you're leaving because the odds are you may not look back and ever see New Jersey again. So we do require, in order to record a deed, unless you have an exemption, that they take a minimum of 2% of the deed price, send it into the state of New Jersey, and then when you finally file your return, again, it acts as a withholding, so it's a credit towards what you may ultimately owe, or you could get the entire balance back if you didn't owe anything. You might get a refund. So it is not a tax, it's a withholding, but it is real and it does have to be calculated at closing. The actual law says you're supposed to go in and calculate how much you owe and send that in, but at a minimum 2%. So I've really never seen anyone put in more than 2%. Everyone just sends 2% in. But if you read the law, it says you're supposed to figure out what you owe the state and send that much in. There's some major exemptions for the exit tax. And the most commonly used one is that this was your primary residence for 2 out of the past 5 years. And so if they check that box off, you're exempt. You don't have to pay the 2%. If you read the regulations, I believe it says that it also, your gain is supposed to be under $500,000 or $250,000 if you're going to check that box. The other time it's exempt is if there's a short sale and you're not getting any proceeds, even if you're leaving the state, or the proceeds are less than, the deed price is less than $1,000. If you're not an individual trust or estate, so this is kind of the opposite of the bulk sale, because LLCs and corporations don't have to pay exit taxes. They get taxed and looked at differently. So if you're an LLC or a corporation, you're exempt from the exit tax. The other thing you can do is you can file in advance certain forms with the state and get the exemption if you're neither of those things, but you can illustrate how there's no gain to be had. There's a form you can fill out in advance of closing, but it takes time, and then the state has to, you know, approve it and stamp it and send you back an official sealed copy that can be recorded with the deed. That's one way around it. If we have a closing where it's a little bit ways off, we can fill out. So the Get Rep 1 is when you owe money. The Get Rep 3 is for the exemptions. Get Rep 2 is when you prepay. And then the Get Rep 4 is a waiver. So if you can convince the Department of Treasury and Taxation in New Jersey that you're not going to owe anything from the sale in advance, they will fill out this form and you can record it at closing. If you end up paying it and you want the money back, there's a form we've been using or suggesting to clients. Maybe Brian knows the best one, the A3128 that they could fill out for when they paid money to the state, kind of an over prepayment of a withholding, and get their money back before the tax returns are actually due. Have you had clients call you for that? Like, we paid this exit tax, how fast can we get it back?
I haven't. Usually we just kind of advise them, you're paying this, it's going to become a credit on your New Jersey return, whether it's your final resident return or your non-resident return. And you'll get it back when you get it back, but it means it's less that you have to pay, later, and just kind of make them wait. I mean, I know it exists out there, but I haven't seen it a lot.
So you usually wait till the forms are, because they don't even promulgate those forms like early in the year. Sometimes you have to wait till they come out for that year, right?
Oh yeah, you're usually waiting until the spring of the following year. So if you sell real estate now and you don't do the, that quick refund claim, you're waiting until probably April of 2021 to file and get your refund from New Jersey.
Right. And so it's just, when people are planning, it's just good to be aware of these things as agents, because you're the first professional they're talking to when they're making their decision about moving out of state. They may be counting on getting every penny from that sale that you guys come up with a number of 450 at, when the reality is they have to pay a transfer tax. They may have to post money for the bulk sale. They might have to post money for an exit tax when they go. So going through that analysis with customers in advance often is very helpful for them. All right, so now we're going to talk about some more broad federal taxes that apply to everyone and aren't just specific to New Jersey. But again, this is not so that everyone can be a CPA, but it's really helpful information to understand some major broad strokes of why people might decide to sell this year versus next year, or hold or not sell, or what their basis is and what they might end up being taxed at. So the first thing, and this is really completely in Brian's wheelhouse because he's a CPA and this is the stuff he deals with. So I'll defer to him on any questions. And by the way, we do have a question. I know some of you guys have chimed in and asked a question or two, but please feel free. This is the one benefit of being here on the live session, is that you can ask questions and we will either answer them in real time, or before we wrap this up, we will certainly get to your question. So the first concept I want to talk about is when someone buys a piece of property and they sell it within a year. In that situation, any gain that they make, and people do this when they're flipping houses or they just happen to buy and sell because of a job change, any gain that you experience from a buy and a sell within a year is considered to be ordinary income. And for the most part, that income is going to get taxed at the highest rate compared to a capital gains rate, at least under the current system. So the 1 year is an important date to know. So if you're marketing and selling a property for someone, they bought it last August, you're going to want to make sure we set the closing date for beyond 1 year so that they can be taxed as capital gains versus ordinary income. The next break point is that if you're dealing with someone who owns a primary residence, you really want to make sure if they're going to be making a gain on the property that they achieve that 2-year time period, because after 2 years, each owner, if it's a married couple, both owners, $250,000 exemption on their capital gains. So that's going to be a $500,000 exemption. That is huge. And setting up a closing date for 1 year and 11 months before that 2-year anniversary on someone who's going to make gain is not going to be good. And so they're going to look around and say, why didn't you tell me this? And not that you're their accountant or you should know, but it is important, I think, if we're in this business, we're the professionals, we're setting these deals up, to have in the back of our minds that 1 year and 2 year mark. And ask them when they bought it, or you could look it up in the records book online. It's pretty easy. So those are really important dates to be aware of. The other thing I think you need to understand when we're dealing with what people are going to owe are the difference between inherited property and gifted property. I have a number of clients. Well, let's talk about the rules first. When you inherit property, you inherit the property as of the date of death at the value on the date of death. So if a property was purchased by a parent, 40 years ago for $100,000, but say it's worth $2 million, usually what happens is when the first parent dies, it gets left to the surviving parent. There's something that's called a stepped up basis that occurs then. So if at the time it was worth $1 million, the original owner who survived would carry his 50,000 basis over, but he would get a stepped up basis of another 500,000 from the spouse who died. So now the property would have a basis of 550. And if later the surviving spouse dies and leaves it to the children, when it's worth $2 million, the children inherit it at $2 million. So if they sold it the next day, there's arguably no tax. I have a number of clients who are, and the opposite is when you gift property. If you gift property, you take over the basis of the person who gifted it to you. So in that situation, if the parent had gifted the property to the kid, they would have taken over the 550 basis that the parent had. Whereas if they waited till they died and they inherited at $2 million. Huge tax savings if you inherit property. I have a lot of clients who own properties and they are intentionally not gifting them to their children because of this incredible tax burden they would be shifting to them. They're waiting for them to go through their estate. And in New Jersey, we talk about this, and this is, again, it's a tax seminar. I'm not going to get too into it, but in New Jersey, we only really we used to always worry about 3 taxes. We used to worry about federal tax everyone has to deal with. And there was something called the New Jersey estate tax. And then there's an inheritance tax. Well, the good news is the New Jersey estate tax is gone. They got rid of it like 2 years ago. Now, it might come back, but it's gone for now. An inheritance tax doesn't apply unless you're dealing with a beneficiary who's not a child or a spouse or a grandchild. But the federal tax, again, because of what's been going on, the limits have been raised. They might not stay that high forever, but they're 11.2 million per person. So there's often no tax that's going to apply from an estate tax, where people are very happy to let their properties flow to their children through the probate process, where they're going to inherit it at the stepped up basis. So, keeping this in mind and understanding that is really important. I'll give you one example. I did a closing last year and we had a very similar fact pattern. And I got the contract in and, I didn't off the cuff look when they bought or what happened. But once I got the title report in, I noticed that it was a very strange situation. My clients were what I'll call the grandkids. And this property had been in the family for years. It was actually owned by their father. And their father bought it for about $100,000. And during his lifetime, he gifted it to his father, which was their grandfather, who owned it with their grandmother. The grandmother died at some point, and then the grandfather gifted it back to the kids, to the grandkids. So they inherited the grandfather's basis, which was only slightly stepped up by the death of the grandmother, and it came to $200,000. Well, we were selling for $700,000, and the closing was 1 year and 11 months and a week after they inherited the property. And I looked at it, I said, guys, do you know what's happening here? When you sell this property, you're going to owe $500,000 in tax unless we put everything on hold and we close it in about a month from now. So we did. We let I think the buyer move in and live there. Or maybe we didn't do that. We couldn't because we needed 2 out of 5 years. But we delayed the closing for a few weeks, and then we did the closing, and they were fully exempt because they each got the $250,000 exemption. So we probably saved them, I don't know, Brian, 70, 80 grand on capital gains tax. And, they were forever indebted. They'll always be my clients. But if you can know the tax law to the extent that it relates to real estate deals and give your client just some general advice, call your accountant, call your lawyer, make sure you're doing this right. You could also be a hero. And that's why I think it's so critical that even just doing transactional work as brokers, as lawyers, we be aware of what the tax ramifications are. Any other comments on that, Brian? Or?
No, I think that's it. It's certainly, for the audience on this call, the answer is understanding those timelines. That is, it's about a 15% rate differential when you look at the difference between capital gains and ordinary income. So that less than a year, which is taxed as short-term capital gains and as ordinary income rates, can go up to 37%, as high as 37% federally, and then another 9% New Jersey, depending on, a taxpayer's circumstances. That capital gains rate over the 1 year drops to 20% on the capital gain, potential maximum of 20% on the capital gain, and another 3.8% on the net investment income tax surcharge that's implemented in 2012. So you're talking about a 23.5, 24% rate. So the difference between 37 and 24, you know, depending on the size of the sale, has some real impact if it's possible to delay that closing a little bit. You know, that's a significant savings for a taxpayer. New Jersey is going to be the same because they don't have any preferential rate. But at the end of the day, being able to cut that down or qualify for that residential exemption if it's their residence, to the extent you can manipulate closing dates to hit those marks, that 1 year and 2 year. I know there's also a question here in the question and answer that's relevant to that is, what if a parent adds a child's name to a condo deed while the parent is still alive? You know, I think in that case, you're really talking about, you know, it would transfer by operational law, right? Upon the parent's death, it would transfer to the kid, and it would be carryover basis. There would be no step up. So you'd lose that step up you talked about on inherited property.
You know, I thought that too, but when I talked to a couple tax specialists that do this estate planning, they said that if you just are adding it and it could be, the state will look at it as just for tax purposes, and you do still get the step up. So I thought what you did, but when I asked a couple tax estate planners, they said they do this and they've gotten away with it,
and they bump it up. Okay.
And they've gotten the step up.
Because I always thought it had to run through the estate in order to get the adjustment and be distributed as a beneficiary of the estate to get the stepped up basis, because the estate becomes the first party entitled to that basis adjustment.
Right.
And
it
then
passes outside the will, but it's still, it's still part of the estate because it passes outside the will. That's what they tell me. I don't know. That's why I'm a real estate lawyer, not a tax estate specialist.
Hey, and I don't do a ton of estate work, so that's why I have specialists that do that every day.
So the final few things we're going to talk about before we'll try to wrap it up just at about an hour, not an hour from now, but an hour for the webinar, is we're going to talk about 1031 exchanges. These are really important, and you could look at these in the context, honestly, of everything we've been talking about. The folks who have a lot of wealth and make money are wise about the tax code. We all know that. And so people often will put a commercial property that'll have in their family for many, many years. And each time they want to get a new property, they can transfer property that's not 1031s. You can't use for your residence, but you can use it for any other investment property. And they're very liberal, very broad on what type of properties you can transfer, but they're very strict on the timing. So when you try to do a 1031 exchange, the overall purpose of it is to swap out properties. I own a property on Main Street. I see this one over on Broad Street I want to buy. I'm going to sell this. I'm going to transfer my basis over. And the 1031, if you do it right, allows you to transfer that basis without creating a taxable event. You're just shifting your basis over to the new property plus whatever additional funds you put in to buy the new property. So they're fantastic tools when you're a realtor to say, hey, you know, someone might not want to sell a property. Why don't you do a 1031 exchange? Not only will I get your listing and sell the property, but I can help you buy the replacement property. The only thing you have to do, though, is there's some strict rules on timing. You have to identify the new property within 45 days of the closing on the sale of the property you're selling. All the money has to go in a special account called an intermediary. There's plenty of them out there. They're easy to find. All the major title companies have one. And the money sits there. The seller can't touch that money. And then within 45 days, you have to identify up to 3 properties that you may use as replacement properties. That's not a lot of time. So when you're selling and marketing the first property, you need to be looking for the replacement property because you have to identify them within 3 days, 45 days. And then you have to close within 180 days. So it's really tight. If you miss those dates, you lose and everything becomes taxable. So again, great tool. Back to my example, people might buy properties and upgrade them and sell them in 1031 exchanges their whole life. And then when they die, it gets left to their children and they get a stepped up basis. So they've avoided paying taxes on a piece of property, sometimes over a period of 30, 40, 50 years by utilizing 1031 exchanges and then ultimately passing through an estate. The state and the federal government gets no tax at all, and you've gotten away with doing this tax-free. So it's a very useful tool, and it's something that you should at least just be aware of as an agent because it means there's a couple transactions. Now, there's one other, do you have anything else you want to add to 1031s, Brian? before I move to opportunities?
No, I mean, I think at a high level, like you said, it's investment properties or properties used in a trade or business. This doesn't work for residences. You could identify up to 3 properties. There are some special rules around identification as well, where you could identify an unlimited amount of properties to replace, so long as they don't exceed 200% of the fair market value of the property you're relinquishing. And you know, Brad talked about the timelines. The timelines are very strict, and the IRS does not like to extend them. They have provided some guidance for 1031 deadlines this spring because of the pandemic. But traditionally speaking, if you miss that identification period by 2 days, you're out of luck and your entire gain is taxable. They're not very flexible.
And as far as the type of investments you can do, they don't have to be just like a house. It could be even in a form of maybe a REIT or even another type of an investment.
There are mostly some Delaware statutory trusts where you're buying an undivided interest in a piece of property. It is pretty flexible. You do need to exchange fee simple for fee simple. So you can't, you know, sell fee and buy a partnership interest. You can't sell a partnership interest and buy fee. There's a lot of creative planning around what you can use to replace. But as far as type of property, it's very, very, you know, very relaxed. If you could sell a retail shopping center and buy residential or vice versa, you know, so real estate is like kind of general real estate. You can even do it with leasehold interest as long as there's at least 30 years to go on that leasehold interest. So if you're going to buy a long-term leasehold interest, that could qualify under 1031 as well.
And someone asked me, does it apply to other areas besides real estate, like with art investment? Can you?
Not anymore.
No, not anymore.
It used to. And they cut that down to just real estate with the TCJA back in 2017. So before 2018, you could do 1031s for a boat, for a piece of equipment, for a collectible.
Oh yeah, good. I'm glad you brought that up because I remember doing those and someone asked and I said I thought you could, but now you can't do that. They closed that.
Yeah, they changed the law in the TCJA. So in 2018, they made it that 1031s are just available for real estate. There are a couple questions on 1031. The first one on a 1031, if there are 3 properties earmarked after the due date, can an additional property be added? The answer is no. Like I said, they're very strict on that. If you get to that 45th day and you've identified 3 and none of those 3 work, you're out of luck and you're not going to be able to close on one of those 3 within 180 days. That's going to explode the 1031 exchange and the taxpayer is going to have to pay the tax. Right. The next question must be like properties, which I think we talked a little bit about. I think we've got that answer.
Yeah. All right. So moving on, and this is somewhat related because it's another way to defer tax, and we're going to talk about opportunity zones. Opportunity zones are a new thing. They were created by the federal government, and the purpose was to identify areas that needed redevelopment and incentivize people to put money in those areas by providing tax benefits. So the basic rule is you have to buy property or I think they're qualified opportunity funds that have assets of at least 90% of businesses or real estate in these particular zones. The big benefit, if you do it, one strange thing is you can't, I mean, you could do this, but if you went and just said, oh, I want to buy one of these, you don't get the deferment benefit, but it's really set up for people who are just about to sell a property. So again, helpful for realtors to know about this because as soon as someone sells a property, if they don't do the 1031 exchange and they don't do an opportunity zone, they're going to be paying taxes on the gain. So sometimes, you know, we talked about how strict the 1031 exchanges are on timing. The opportunity zones have a lot more flexibility. First of all, you can get the money in your pocket on day one. They don't limit, you don't have to use an intermediary, but they have that same 180-day rule. But if, for example, you identified 3 properties and one of them didn't work out, and now you've blown your 1031, you could pivot to an opportunity zone, invest in them. You don't get a deferral forever like a 1031. You get a deferral till December 31st of 2026. But you get something else, which is amazing. You get, if you hold the investment for 10 years, everything you earn over the life of that investment is fully tax-free, which is kind of unheard of in the federal tax system. So it's an incredible, what they say, opportunity to for taxpayers to come in and invest in these areas. Brian, I know, said he gets probably 2 or 3 questions a day on this stuff. Is there anything you want to maybe share about the questions you're getting? And people might be.
Yeah, I mean, ultimately, I'll give, and Brad kind of hit on a few of the benefits. Obviously, this one does allow you the benefit of hindsight. The 1031, as Brad mentioned, when you're doing the deal, you have to lock that cash up with an intermediary at sale. You can't touch the cash and then decide later, oh, you know what, I should have done the 1031. Let me go do that now. With an opportunity fund, you can sell an asset. It doesn't have to be stock. It could be stock. It could be real estate. It could be anything. This is beyond just real estate. So any capital gain that a taxpayer has, they can then reinvest that via an opportunity fund, and they get those 3 tax benefits: the temporary deferral to 2026. They get some basis adjustment within that period of time. Once they've invested in the fund for 5 years, 10% of that gain is never taxed. And then, as Brad mentioned, the real carrot is once you're after that 10 years, you get tax-free on all appreciation. So if you invest $1 million in an opportunity fund, you sell it for $5 million in 12 or 13 years, you sell that investment, that whole $4 million is tax-free, and that's great. I mean, the biggest questions we get now are proper structuring. There are some really particular rules around how these things have to be structured. There are some really particular rules around qualified opportunity funds and their need to do semi-annual testing of their investments to make sure that they have enough assets in qualified opportunity zones in order to continue to qualify and not be subject to penalty. And then we do a ton on exit planning. Obviously everybody looks at this and they say, I got to lock this money up for 10 years. They want to talk a lot about that exit and how am I going to get my money back? So, it's been some of that. The timelines for these have been relaxed recently as well by the IRS, but ultimately if the taxpayer sold an asset, even if they sold an asset now at the end of 2019, they could still make a decision, because we're still within 180 days of late December, they could still make a decision to reinvest in an opportunity zone and avoid paying that tax on their 2019 tax return, which is coming up due July 15th if they haven't filed yet.
Yeah, again, great advice. Like if you're talking to customers, they don't know what to do with their money, they're worried about paying a tax, just remind them, hey, did you look into 1031s? Have you looked into opportunity zones? Even after you sold, opportunity zones, they're very flexible, and there's opportunities for people to save some money. All right, moving on. We just have a few more things, and we're going to wrap this up probably within the next 10 minutes. Controlling interest tax. We talked before about realty transfer taxes a lot. And clients have come to me and said, well, I'm buying this LLC. What if I just, instead of buying it from them in a new LLC, I take over their LLC? Then there's no recording of a deed. I just became the new owner of their LLC. You would effectively avoid any transfer tax, any mansion tax that was applicable. That's true. But the state did come up with a rule that says whenever you have a shift in the controlling interest of an LLC or corporation to new principals, there's a 1% tax on the value of the assets of that corporation. But what they left out is that residential properties were exempt. So sometimes we'll do deals where there's a large apartment building, maybe 30, 40 units, it could be any size, honestly, and it's zoned residential. In those deals, it does make sense to often go through and purchase the LLC. Now, it's generally better to start your own new LLC because you don't have to do as much due diligence and vetting out of the old one, make sure there's no taxes or other debts owed. It's out of a clean start. But if you're going to save the 1% and the transfer tax, and it could be really high depending on how big of a transfer it is, often we'll go with the taking over the LLC or the corporation. Another topic related to tax is short-term rentals. In New Jersey last year, we got a new law, the Airbnb tax, which is 11.625%. Good news for everyone who's listening, who's a realtor, is if they use you, you're fully exempt. You probably know that. And then in last August, I guess it was, they modified it. And even if you are, as long as you're not using one of these websites like VRBO or Airbnb where they take the money out, you can, if it's a private sale that you've done, or a private lease rather, those taxes don't have to apply. Because there was a big public outcry where they said, look, I've been renting the same guy for 10 years. Why do I have to now pay one of these taxes? The answer is because the hotel lobby was upset that Airbnb was taking their business. And they said, look, state, they're stealing revenue from you too, because people are going to Airbnb instead of hotels for these short-term deals, and you should capture that tax revenue. So that's just something also to be aware of. And, you know, since we're in the midst of a pandemic, I just figured I'd bring up a couple points about changes because of COVID. The one that relates to real estate directly is the governor issued one of his earlier orders that said if you're filing a tax appeal, it is delayed. Originally, it was delayed for like a month. It was supposed to be April 1st. They delayed it to May 1st. And then it said, or 30 days after the state of emergency is ended. So as of right now, we're still in a state of emergency. It was just extended to July 6th. So the earliest you'd have to file a tax appeal, assuming it expires July 6th, would be August 6th. So that's a nice benefit. If you have any customers who you think would benefit from a tax appeal, they still have the right to file that. Normally they would not. And obviously, I think most people also know that the delay on filing your taxes to July 15th. Brian, any other COVID-related tax benefits or comments you have?
No, I mean, my only advice would be if people are struggling right now or they're not sure, you should really point them in the direction of their accountant. There is a lot out there that's, you know, obviously beyond the scope of what we're talking about today with respect to relief on timing and extensions of time for certain of these transactions. 1031s and opportunity zones peak right away. I think there are some extensions out there with COVID relief. But from a general tax perspective, there's been a few big acts of tax legislation signed to stimulate the economy that have changed a lot of tax laws. And you should certainly be encouraging your clients to speak to their accountants and make sure that if they're looking at real estate deals, whether buy or sell, they're taking advantage of all the opportunities that exist right now with expanded NOL carrybacks and all these other things that exist under the new law in light of the COVID crisis.
The final topic, and this came up a couple times in prior seminars as questions, so I figured I'd hit it, is folks who are not New Jersey residents and whether or not they owe taxes on property in New Jersey. And I learned from my CPA that the answer is yes, they do. You have to pay a New Jersey tax if the property that you are either renting is generating income or that you're selling has generated a gain. You owe a tax to the state of New Jersey. And the only saving grace, although it doesn't help some people who live in very favorable states, is you do get a credit for the tax you paid in your home state to New Jersey. So unfortunately, New Jersey is going to get you if you're an out-of-state owner. And I think that's just about it. There's a couple more questions. Where can we find opportunity zones? There's a website. We could send you, Brian, any comments on that?
Yeah, you could. Yeah, I mean, you could certainly reach out to me. I think there's a few websites that exist. I think New Jersey DCA has one on their website. I know our website has one under our Opportunity Zone Resource Center, an interactive map where you can search for different census tracts that would be qualified opportunity zones and make sure your property is located inside them. They're out there on the internet. I mean, you could Google it and probably find 10 of them, but there are maps out there.
Yeah, and they're all over the place. You'd be surprised. Many towns in I practice in Monmouth County, and there's a lot in our area. You'd be surprised that how close by they are. What if ownership of the LLC is abroad? I'm not quite sure if I can fully understand that one.
Transfer fee? It's probably on the controlling interest transfer fee. I think that probably doesn't matter at the end of the day, right? If the controlling interest transfers, it doesn't matter who it is. If the real estate's here in New Jersey, that's what they're looking at.
Yeah, if that's the transfer of the asset. So, so I think we've hit just about. Let's see, Brian, can you explain what types of real estate investments qualify in 1031? I think we kind of talked about that. Unless you want to add something to that, Brian.
Yeah, I mean, ultimately, any kind of real estate that you sell will likely be able to be replaced by a Delaware statutory trust if you could find the right one. They function a lot like tenancy in common interest, the Delaware statutory trust. So in effect, you own an interest in a trust, which gives you an undivided percentage interest in the assets of the trust. There are a lot out there that are pretty broadly marketed. You could certainly, if somebody has any questions, I'd be happy to talk about more specifics offline, but real estate is relatively flexible, and the DST what it gets you is it gets you an undivided interest in whatever is owned by that trust. So it qualifies as a like-kind asset.
Yeah, so I think that's about it. Thanks for everyone. We're recording this, and it's going to be available on my website. If you click on the top corner where the YouTube button is, we have a YouTube channel where we're recording all these webinars. We also have a podcast. So if you click on the iTunes logo or search us under Apple iTunes, you can find this as a podcast if you or anyone you know wants that. And like I said, if you want the handout materials, just send me an email, brad@bachelorlaw.com. Or give us a call anytime, 732-747-8300. And Brian, if you want to give your information, if anyone wants to reach out to Brian too.
So my email is blovett, Lovett, @witham.com. My direct is 732-964-9343. And you can get me anytime.
So thanks again. Stay in touch, and like I said, don't become a CPA, but please be aware of the things we talked about today, because I think they can really enhance your practice, and I think your customers will truly appreciate it. So thanks a lot. Have a great day, everybody. And thanks Brian.
Everyone.
Appreciate you being here.
No problem, Brad. Thanks for involving me.